I think, sitting through all the sessions, a couple of terms I've heard recurring through all the discussions that we've heard so far. Supply chains, energy security. I think we can all agree that energy security and the global energy supply chains have really faced a period of profound disruptions. Rapid technological changes, heightened market volatility, shifting political priorities are all reshaping the energy landscape at every level. And these shifts are not only changing how energy will be produced, transported, and consumed, but also how investors, governments, and corporations are thinking about risk, resilience, and opportunity in the global supply chain for energy. And we track the money and the investment that's going into the global clean energy supply chain. And in 2025, we've tracked that about $127 billion have gone into clean energy supply chain, which is up about 6% year on year. And this is no longer just a niche manufacturing story that we see playing out in China, but a wider capital allocation theme that's playing out across a broader set of geographies. Government wants control of technology, they want jobs, they want supply chain security, and the composition of the investments is also changing, which really gives us an insight into what is top of mind for the industry. And last year, about half of the investments went into battery manufacturing. What we see, the investments that go into the production of battery metals, which is lithium, cobalt, and nickel, is also growing. But the share of solar have really fallen quite significantly from its peak in 2023. So governments and corporations are rethinking what energy security means and how do they define energy security. In the past, the question was pretty straightforward. Do we have enough access to coal, oil, and gas? And can we get them to go where we need to in time, affordably, reliably, and at scale? This is a question that's now increasingly difficult to answer and increasingly difficult to plan about. And the Straits of Hormuz really highlighted how exposed the global oil and gas supply chains are again. The disruption of the Straits of Hormuz took out about 20% of global liquefied natural gas supply and about 30% of global seaborne crude oil trade. And about 80 to 90% of those actually are destined for Asia, with China accounting for more than a third alone. And what started as an initial regional conflict quickly escalated into a global energy supply chain threat. In the wake of the Gulf conflict, which unfortunately is still playing out, fossil fuel prices really took to the sky, reaching about 1.4 to 1.6 times of prices that we saw in January of 2025. And this escalating Middle East conflict really highlights how continued fossil fuel dependence could pose a threat to global economy. And nowhere is that more evident than in emerging economies, such as here around the Asia Pacific, where higher prices means higher costs for power generation, industry, and transport. And energy security is no longer just about physical supply, because even when cargoes do arrive, affordability becomes a very real concern. For governments, this could mean increased fiscal pressures. For corporations, this could mean pressure on margins and cost competitiveness. Many markets here, especially around in Southeast Asia, in China, in India, are still very heavily reliant on coal. And this has prompted a discussion of could we see a comeback of coal as part of the energy security question? And while coal could provide a buffer in the short term for countries that are dependent on the import of coal as a fuel, it does not actually resolve the underlying energy security concerns. And this point was, again, recently underscored by discussions in Indonesia, where there were talks of potentially consolidating coal exports under a state-owned entity. And this adds another layer of uncertainty for coal buyers. Instead, what we think is that the conflict in the Middle East could actually accelerate the energy transition because it reframes the energy transition from this country from just a climate policy choice to an energy security and affordability strategy. And this is also highlighted in our BNEF latest annual New Energy Outlook, which is our long-term modeling out to 2050 of how energy systems could evolve under two scenarios, a least cost scenario and a net zero scenario. And what it really shows is the faster that economies could reduce their dependency on fossil fuel imports, the stronger it could improve its energy resilience. And across most major markets, the transition to low carbon technology actually sees their energy imports as a share of GDP decline. So if the old question was, how do we have enough access to fossil fuels and get them to where we need them to go? What are clients increasingly asking? What's the industry increasingly asking? And people are increasingly asking, what's our exposure to supply chains and our exposure to geopolitical chokeholds? And so we took a look at how many times the terms reshoring, onshoring, and friendshoring were mentioned in Bloomberg News over the years. And we see that starting from 2022, the mentions of those terms have gradually increased, but really spiked into 2025. And then geopolitical headlines dominated the news cycle, and we saw quite a sharp dip. But what is clear is that supply chain strategy is now a main part in the mainstream state of government, corporate and government policy discussions. We also see this in the increased implementation of protectionist trade measures, such as trade tariffs on equipment or product that are imported, or other forms of trade pressures, such as the European Union's carbon border adjustment mechanism. To be very clear, these are two very separate mechanisms. Trade tariffs are implemented to encourage domestic production and to level the playing field, while the EU CBAM mechanism seeks to address emissions and carbon leakage. But what this means is that it matters now where a product is produced. It matters how carbon intensive it is. Some countries are taking it a step further by limiting or restricting the use or import of equipment tied to the product's market of origin. Take the US, for example. For their clean energy investment tax credit under the One Big Beautiful Bill Act, they are prohibiting the use of product or the proportion of costs tied to what they term as prohibited foreign entities. So for developers, this creates a much more complicated optimization problem, because your task is no longer just to procure the cheapest, most affordable, cost-competitive product. We now need to know where this product is made. Could it affect our chances of getting tax credits? Would the ownership structure of the factory that produced this create any risk for us in the future? And the restriction of Chinese products in some markets are already reshaping global trade flow by redirecting supply to emerging markets where demand for affordable clean technologies continue to rise. And we see that China's export for lithium-ion batteries, electric vehicles, solar and wind continues to boom across emerging markets as their exports to developed markets starts to shrink. At the same time, despite the surge in policy attention, we see that onshoring efforts across markets such as the US, Australia, and Europe have actually been slow to materialize. Projects have either faced cancellations or delays as they face cost and demand realities. And while localization can increase energy security, it can create jobs, it can create domestic manufacturing capabilities, there is a trade-off in that it can also raise near-term deployment cost. And we have two examples here. BloombergNEF estimates that to produce a solar module in the US and the EU remains quite substantially more expensive than producing one in China or Southeast Asia. And Italy actually provides another clear example. In their solar auction, the implementation of the European Union's Net Zero Industry Act, where they exclude projects that were using Chinese-made products that were made in mainland China or made by Chinese-owned firms, led to an average weighted bid price in that particular auction round that was 17% higher than a previous solar auction held within the same year, but without their restriction. And the trade-off becomes even more persistent due to this global overcapacity that we're seeing, be it battery cells across the entire solar value chain. Current operational manufacturing capacity is more than sufficient to meet 2025 demand already. And what we see is that even though manufacturing capacities outside of China continues to grow, costs, supplier debt, skill continues to favor incumbent supply chains, and these are advantages that are very difficult and challenging to move. So China's dominance in this supply chain still remains, and that's a reality that will be difficult to change in the near term. And the last question that people are asking as well is, do we have access to the metals and critical minerals that we need to build the future energy systems? Under BloombergNEF New Energy Outlook long-term scenario modeling, again, we see that there will be massive deployment of these transformative low-carbon technologies. The momentum for many of them are already well underway, and all of these would have impact on the demand for energy transition metals. Again, through our transition metals outlook, we take a look at the impact. And leveraging on our 2025 results, we see that the metals that are expected to grow most significantly are all closely linked to the transport sector. So demand for lithium, graphite, rare earth, manganese are all expected to triple by 2050 because EVs need these for their batteries, they need the rare earths for the magnets. And again, if we look at the refined supply chain of these metals, we can see China's dominance clearly shows through. We track 11 energy transition metals, all of which are exposed to significant supply chain risk, which was defined as if the top producers controls more than 30% of global supply. And all but one of these refined supply is dominated by China. And of course, this has prompted a lot of response from governments all around the world. Governments are coming up with policies, with partnerships such as the US-Australia Framework for Critical Minerals. Australia, Brazil, Canada, and Tunisia, South Africa together hold some of the highest concentration of these critical minerals. And these 5 markets have together provided about 45 billion of financial and fiscal incentives in order to spur additional supply chain to diversify reliance on China itself. So resource-rich nations are really now asking, what is their potential role in future global supply chains? Governments, corporations are faced with choices. Do they have to choose between, do they remain exporters of raw materials, or do they try to capture more value by processing and refining these materials locally before exporting them? But whatever it is, the question of risk, resilience, control would be one that governments and corporations will need to balance forward. And so I'm really looking for the panel that follows to learn about how we can redesign ecosystems to be more resilient in the future. Thank you.